Okay, now the next piece of this is I'm following right along with the chapter notes, and the next piece is on the operating budget. Okay, this is the master budget, and it focuses on the income statement. You've got to have the financial budget done to be able to do the balance sheet. Okay, and actually it's hard. It's trickier than you think it would be. So this is for a manufacturer. This is a budget for a manufacturer, and the budgeted income statement and a pro forma income statement. In other words, what the income statement is going to look like for next year. Okay, and you can see that we've got a gross margin here, so this is not in a variable cost format. This is a traditional income statement, and this format is perfect. You guys should all know this, you know, that after operating income, we've got interest expense or interest revenue. Okay, in other words, non-operating revenue. That's what it is. Everything above that has to do with operations, and everything below is all the weird stuff. So we've got interest expense, interest revenue, that's all there. Okay, income before income taxes, less income tax expense is net income. Okay, and then the budgets that flow into these numbers would include, first of all, your sales budget, obviously for sales. That's the first budget that's done. Everything comes from sales, so this is an important department to have a good relationship with, and a time when you really want to understand your business and know where their revenue comes from and what the industry looks like for the next year. What's the national and global outlook look like? You know, where is demand? Where's the competition? There's so many things to pay attention to here to make sure that you've got a solid sales forecast, okay, or budget. Then once the sales budget is done, we can produce a production budget. Once production is complete, then we can figure out how much direct material do we need to support production, how much direct labor, and what our manufacturing overhead would be. And remember, with manufacturing overhead, that this will have two pieces. It'll have a variable cost piece and then a fixed cost piece. Okay? And that whole thing becomes cost of goods sold. That's where it goes. The more difficult ones here are production and direct materials. Those are the two harder ones to do. Direct labor is real straightforward, and so's manufacturing overhead. Selling, general, and administrative expenses are, you know, sort of one lump. This could be a flat number, or maybe there'll be a slight increase to it. There might be a change, but this is also generally an easy number to do. And from that, we get a budgeted operating income, add non-operating expenses, and we get budgeted net income. Okay? So the sales budget is our favorite one. That's the easiest one to do. It's prepared first, and it is simply budgeted volume times the selling price. And I want you to start right away paying attention to what is a unit and what is a dollar. Okay, so it's volume times the dollar per unit. Okay, be really careful with this because this will be mixed around all over the place. So start getting good habits. You can always throw a dollar sign on someplace for the selling price. Okay, and this would give us budgeted sales. Yeah, cash receipts forecast would be separate. We won't talk about that yet. So here's an example of a budgeted sales, or a sales multiple choice question. So we've got sales, cost of goods sold, and gross margin. 317. Operating expenses are 264,535. Okay, let's see. So Advanced is developing the 2019 budget. In 2019, the company would like to increase selling prices by 13.5%. Okay, and as a result, expects an increase in sales volume of 9%, or a decrease in sales volume of 9%. All other operating expenses are expected to remain constant. Assume that the cost of goods sold is a variable cost. It's a really important statement. So all of this is variable. Okay. And that operating expenses are fixed. Okay, so all your variable costs are here, and that's fixed. Well, that's never going to happen, but we'll pretend. So what is the budgeted sales for 2019? And what we can do, but it asks for budgeted sales, so it'd be sales of 961 times 0.135. And then a 9% decrease, right? So minus 0.09%. Okay, and that should give you 992,569. You know what? I think this has to be times, not minus. It's got to be times, because the reason why you can have like a simple formula like this is because it's multiplication, you know. Okay, so now let's look at a production budget. So sales is real straightforward. Production though, and you should remember some of this from 2071. But so now that we know what we're going to sell, we're going to calculate what we need to produce. And this formula is one that's used throughout budgeting. Okay, we're going to have budgeted sales, add a target ending inventory, subtract beginning finished goods inventory, and this is how much we need to produce. Okay, that's what we have to produce. That's the important part there. So you want to remember that no company wants to start the month with nothing, okay, with nothing at all. So there's a target ending inventory. It's how much they've got to have on hand when they start out before production can catch up. I mean, they're not trying to build inventory, you know. And then we can subtract beginning finished goods inventory. And this is the example right out of the textbook, which is pretty good. Now this is, it took me forever to figure out, but this is Congo corn. They buy corn and they make frozen bags of corn. That's what they do. Okay, so the company has a policy of keeping 10% of next month's planned sales on hand in ending finished goods inventory. All right, ending finished goods inventory for 1 month becomes next month's beginning finished goods inventory. So here we have, let's do August 1st. All right, we've got a targeted income of $34.50 for next month. Okay, $34.50. So we want to have in July, we want to have 310% of $34.50 or $345 on hand. So the total units that we need, okay, is $38.45. And then, you know, let's say they told us that your beginning inventory was $350. Okay, that would be a better way to sort of learn it. What they're pointing out here, though, is that that beginning inventory would have been 10% of the current month's sales. Okay, because I mean, if it was the prior month, you would take this month times 10%, and that would be the beginning, or the ending inventory for 1 month is the beginning inventory from the next. So this would have been the ending inventory from the prior month. Okay, and I'm making it way too complicated, but ask me about it if it doesn't make any sense. So here I've got 10% for August. Then we're going to get 10% of the next month, $359, minus beginning finished goods inventory. Beginning inventory would have been ending inventory in the prior month, $345. Okay, so the units to be produced, 3464. And then I want you to pay some attention to what's going on over here. Okay, that this is budgeted sales volume plus the target gives us how much we need, minus beginning is how much to produce. Okay, so sales volume plus the targeted ending inventory gives me the total units that I need, but I have 350 on hand, say in July, so I need to produce 3495. Don't ignore these titles because you're going to need them. And if it asks you, you know, how many new units need to be produced, you've got to know that it's that number. Okay, so here's an example. We've got this is a class problem. Yeah, 6.1. What do we have? Hold on one second. Okay, this is the first class problem. And it's about earned. He's learning the ropes in his new, where do they get these names, you know? Learning the ropes in his new position, looking over the production department's budgets for the past 2 years, and he notices that his production department requires information from the sales division. In turn, the production budget is sent on to other departments. So now that he sees how it all fits together, he gathers the following information. And these are the budgeted sales volume for January, February, and March, and we'll have to have another month in there. Okay, like like if we figure out the target ending inventory for March will be some, say, 15% of April's sales. So we need April's budget as well. Okay, the budgeted selling price is $25 per unit, so that makes the sales forecast easy. It'll just be these units times $25 per unit. Let's take a look at that. Do I have a solution there? I don't think I do. Okay, so here's our solution for the sales. Here's our budgeted sales volume for January through March, because we're budgeting for the quarter at $25 per unit. Here's our budgeted sales revenue for each month. Okay, now let's take a look at the production, at the rest of the assumptions here. So budgeted price is $25 per unit. The desired monthly ending inventory is 15% of the next month's sales. And beginning finished goods inventory, see here they're giving you a number, it's 420 units, but they're also telling you the production department currently holds slightly less than planned because December sales exceeded their goals. Okay, so now let's take a look at the production budget. So let's look at the formula here first. I've got our budgeted sales volumes. This is in units, right? Budgeted sales volume. Add the target ending inventory. Gives us the total units needed. Okay. Less beginning inventory. That number was given to us. And there's our budgeted units to be produced. Okay, so our target ending inventory is 15% of the next month's volume, so 2,700 times 15% is 405. 3,500 times 15% is 525, and then for April, whatever those April sales were, times 15% is 570. Okay, but we need April to be able to get this number. So these are our total units needed. Less beginning finished goods inventory. The 420 was given. Now beginning inventory is going to be ending inventory from the prior period. So this 405 is right here, target ending inventory. Okay, 405. 525 was 525. And this is the total for the quarter. One other sneaky thing about the quarter, the target ending inventory for the quarter is going to be this March right here, that 570. That's the end of the quarter. And the beginning finished goods inventory is going to be the beginning of the quarter, so that's going to come from January. Okay. All right, then they've got a couple other softer questions here, like after doing the production budget, then they've got to do direct materials, direct labor, overhead, and SG&A. Okay. So, and you have to have sales and production first before you can do anything else. All of these solutions are available in the folder too. Okay, and then the last one, they asked about inventory. Some of the reasons why you might want to change your inventory level is that if you've got like risk and not being able to get your direct materials, so you don't have enough for production, or if there are workers leaving for other employment options, or if too many workers are taking time off at the same time. Okay? All right. If there's a potential for substitute products not being available, just take a look at this. So there are all kinds of reasons why you might change that inventory number. Okay.